Markets are shaking with a 10% S&P 500 drop. Should you panic or is diversification your weapon? Hey everyone, welcome back to the Stock Bro. It's your weekly market update, and volatility is back with a vengeance. Stocks are down, uncertainty's up, but some investments are shining through the chaos. We're diving into the numbers, the winners, and what's next. New here? Hit subscribe, grab a snack, and let's get into it. Let's start with the markets. It's been a bumpy ride. The S&P 500 dipped into correction territory Thursday, down 10.1% from its February 19th high. It closed at 5,639, off 2.3% for the week, and it's now down 4.1% year to date. The Nasdaq hit harder, down 14% from its peak at one point, landing at 17,754, off 2.4% this week and 8.1% for 2025. The Dow dropped 3.1% to 41,488, now minus 2.5% this year. That's the first 10% S&P pullback since October 2023, over a year and a half ago. But here's a twist, not everything's tanking. Value sectors like financials and cyclicals held up better than tech and AI stocks. Bonds are actually up for the year. And international markets like Europe and China are outperforming with 8 to 10% gains. Diversification's the MVP this week. We'll unpack that soon. Overseas, the MSCI EAFE fell 2.1% this week, but stays up 8.1% year to date. Meanwhile, the 10-year Treasury yield is steady at 4.32%, and oil is flat at $67.14. Markets are volatile, but some pockets are thriving. Within the US, 5 of the S&P 500's 11 sectors are still positive for 2025. Defensive and cyclical names are stealing the show, while tech lags. It's a tale of two markets, and it's all about where you're parked. So, what's sparking this chaos? First, the economy slowing down. Q1 2025 data is pointing to softer growth. Consumer spending's fading, and sentiment surveys show folks are getting wary. After a strong 2024, the US is shifting gears, and markets hate uncertainty. Then there's policy noise. Tariffs are back in the headlines. Uncertainty is stalling consumer spending and corporate moves. Companies are delaying big investments, even IPOs. Check this out. IPOs over $50 million are way down compared to the past decade. Everyone is waiting for clarity. Let's talk valuations. Coming into 2025, US stocks, especially mega-cap tech, were stretched. Think Nvidia, Apple, sky-high PE ratios. Investors are rotating out those pricey names, piling pressure on the S&P and Nasdaq. The S&P 500's forward PE is still higher than Europe's Euro Stoxx 50, so that shift makes sense. But here's the good news. Corrections like this are totally normal. Since 1928, we get 1 to 3, 5 to 15% pullbacks a year. This 10% drop's the first big one in over a year. No recessions in sight yet, so this could be a chance to pounce. Volatility is ugly, but it's not the end of the world. Hang tight, because some parts of the market are actually doing great. Let's spotlight the winners. In US stocks, value is beating growth this year. 5 S&P 500 sectors are up, like healthcare and financials. Why? They're defensive. Think hospitals, banks, and cyclicals tied to economic cycles are holding steady. Tech and AI? Not so much. I'm keeping an eye on healthcare and financials. They could shine if deregulation or tax cuts kick in later this year. Imagine lower corporate taxes boosting banks. That's a tailwind worth watching. Across asset classes, bonds are the unsung heroes. The Bloomberg US Aggregate Bond Index is up 2.3% year to date, outpacing stocks. Why, you may ask? Yields dropped. 10-year treasuries went from over 4.5% earlier this year to 4.32% now, as investors ran to safety and priced in Fed rate cuts. And internationally, Europe and China are killing it. The Euro Stoxx 50 is up over 10% this year. Germany's rocking it with rate cuts and fiscal stimulus. Chinese tech is riding stimulus vibes too. These markets offer better valuations than the US, and investors are jumping in. Compare that to the S&P 500's pricey PE. Europe's a bargain, and it's paying off. Diversification's saving the day here. See the pattern? While US stocks wobble, bonds and international markets are stepping up. It's a diversification masterclass. Let's zoom out. 2025 is proving why diversification matters. After 2 years of tech and AI driving 20% plus S&P 500 gains, this year's flipped the script. The S&P is down 4.1%, Nasdaq's off 8.1%, but a simple 60 to 40 portfolio, 60% stocks, 40% bonds, is holding up way better. Why? Bonds are cushioning the blow, and value stocks are balancing out tech stumble. If you're diversified, say with healthcare, financials, bonds, maybe some Europe, you're not feeling this as bad. It's not sexy, but it works. And here's the bonus. The Fed might help. Markets are betting on rate cuts later this year as growth softens. If 10-year yields creep back up to 4.5%, bonds could get even juicier. Longer duration looks smart right now. And I know, international stocks might not always outpace the US long term. Our productivity is a beast, but this year, they're a diversification win. Europe and China could keep shining if US growth stays soft. The point is, volatility is rough, but it's opening doors. Corrections like this, they're chances to rebalance or snag quality investments. Stocks, bonds, global plays. What's ahead? Next week's huge. The FOMC meeting drops rate clues, and retail sales data hits. Weak sales could fuel more Fed cut bets. Strong numbers might steady the ship. Either way, volatility is not done yet. Big picture, this 10% drop is normal. We get 1 to 3, 5 to 15% corrections yearly since 1928. No deep bear markets brewing without a recession, so this could be your buying window. Your move? Long-term investors, stay cool. Time in the market beats timing the market. Rebalance, maybe boost bonds, value stocks or international. Start a watch list if prices dip more. Chat with an advisor to keep your goals locked in. Volatility is your friend if you play it right. Here's the weekly tally. Dow at 41,488, down 3.1%. The S&P 500 at 5,639, off 2.3%. Nasdaq at 17,754, down 2.4%. MSCI EAFE is at 2,444, off 2.1%, but up 8.1% year to date. 10-year yields 4.32%. Oil at $67.14, and bonds at $98.28, up 2.3% year to date. So, are you buying this dip or waiting it out? Drop a comment. Love hearing your takes. If you want to be fully caught up, make sure to watch last week's video on screen right now. And don't miss next week's video. FOMC could shake things up. Don't miss it. Thanks for watching. And as always, happy investing.